Good afternoon, or potentially good morning if you're coming to us anywhere west of Eastern Time. And welcome. We're so happy you could join us today. We will be going over our third quarter 2024 market and economic update. I am Ryan Bouchey. I am the Chief Investment Officer here at Bouchey Financial Group, and I am joined alongside my colleague Paolo LaPietra. He's a wealth advisor and portfolio strategist with our firm. And behind the scenes, we have Katie Buck, who is going to be helping with our slides, audio, and all the technical intricacies of this production. As a reminder, we typically do have the Q&A or the chat function open. So as we go through the presentation, if you do have a question, feel free to reach out. We'll try to touch upon it if we see it. We'll try to get that answered as we go through. Or as always, you can always follow up and reach out to us after the presentation is over. We will have a recording and the slides available as well, as we typically do, that we'll send out post live webinar. So today we'll go over the market and economic, as we say, the momentum that we're currently seeing, whether it's within the stock market, whether it's in our economy. We're seeing a lot of positive momentum. We'll go through a third quarter market recap. We'll touch upon just a general economic overview. We'll hit on Fed policy and what that impact has been. We saw recent changes in the last month or so, so we'll certainly discuss that. We've seen, it's kind of we talked about it in the quarterly letter, but certainly seen a change in the market dynamics over the last 3 or 4 months. We'll talk about what we're seeing and how that impacts the portfolios. And as we move forward, just our market outlook and expectations as we enter the last quarter, believe it or not, of the calendar year. So as we jump in, the bull market, pretty self-explanatory. This bull market continues to move forward. And a big theme of our conversation last quarter was, all these fears that are out there, everything that we can be kind of worried about, and maybe headline risk, what you're hearing. But as we said, there's always things to be concerned about within the market, and that just feels as though the general theme of these last 2 years, as we've seen another in the S&P right now, 20+% return year to date. Who knows what'll happen as we finish off the year, but between last year, this year, we're seeing just some real strength in the overall markets. And as we look at just the year-to-date market performance recap, as you can see in the green and red, I mean, the Dow, or not the Dow, the S&P and the NASDAQ are essentially, side by side in terms of their performance year to date, up about 23%. This is as of yesterday's midday market. In blue, we have the Dow Jones, a little bit lagging there, up 16%. The Russell 2000, which is U.S. small cap stocks, up about 13%. And lastly, you have the Bloomberg U.S. Aggregate Index. That's really the benchmark for the total fixed income market in the U.S., up around 3% year to date. And I think the big, highlights here, right? We said the S&P and the NASDAQ leading the way. We have some, decent divergence between what the Dow, what small caps are doing. Obviously, in a bull market like this, fixed income is generally going to lag. Still doing better than we've seen in many years, but we've seen kind of a decline in that U.S. aggregate index over the last month, and we'll talk about the effect from the Fed and what we're seeing there as the presentation goes on. And when we look at just our portfolio tactical allocation, we kind of like talking about these, areas of the market that were, maybe overweight, underweight, as we discuss our overall portfolio. And honestly, from an overweight in equity standpoint, we really haven't changed much. A lot of the equity tactical maneuvers we made were earlier this year in sort of expectation of what we're seeing and where we're at today. We really like how the portfolio is allocated there on the equity side. We have obviously an overweight to U.S. equities. Technology continues to be a strong area of the market. You saw again how the NASDAQ has done. That's primarily weighted in technology companies. in that overweight in the tactical nature of those quality and growth metrics that we've probably been talking about for quite some time. And as we've seen as that market dynamic shifting in that rotation that we're seeing in the third quarter, areas of the market that we've been really, really happy with. Underweight, again, this has been a theme of ours for quite some time, international equities. We're not too specific with exact sectors right now. We've kind of gone with more factor investing on the equity side, like that quality, like dividend growers, areas that we think, aren't necessarily tied to any one sector, just more with a general theme of the underlying security. Small caps, we continue to be underweight, and we'll get into that a little bit later in the presentation, as well as, we're starting to make a move away from shorter duration bonds as the Fed is lowering rates, and we're kind of seeing on the longer end of the curve, the yield curve, some changing in some rising of interest rates, believe it or not. And those are some areas we'll talk about as the presentation moves along. So with that, I'm going to turn it over to Paolo. He'll get into a little bit of the economic overview.
Thanks, Ryan. So let's kick off the economic overview by taking a look at the NBER, which stands for National Bureau of Economic Research. And I wanted to start here because there's been plenty of differentiating views on the state of the economy over the span of the Fed's, previous rate cycle. And at the end of 2022 and the start of 2023, the consensus was that we're headed into a recession. And you fast forward to the start of this year till now, it's a soft landing, and the chart that we're looking at here certainly supports that. Here we're looking at 6 different areas of the economy on a month-over-month basis. Red means contraction, yellow means softening, and green shows growth. And if we look all the way to the right of the chart, we're seeing a mixture of softening and growth. And even more importantly, if we look at the bottom of this slide, here we're looking at the same 6 areas of the economy, but looking at changes over the last 6 months. And we could see positive growth in all 6 areas, with the US consumer and labor leading the charge. Now, I've talked about this before on how important the health of the US consumer is for the US economy, with the US consumer making up over 70% of the US's GDP. So on the next slide, let's take a look at the US consumer. So I really like this chart on the left because it shows how the behavioral pattern of spending changed through the pandemic. Here we're looking at 3 different spending categories: durable goods, which is in light blue, and durable goods are things like appliances and cars, essentially, anything that's intended to last for a long time. Then we have non-durable goods in gray, and for non-durable goods, they're just the opposite of durable. Think, food, clothes, things of that nature. And finally, services in dark blue, which could be, things like restaurants and barbers, people in the service sector. And what we'll see in 2019, which is all the way to the bottom left, is a healthy growth across the board between 2 to 3%. But then a drastic change in 2020 due to COVID, and these changes made perfect sense. We could see a dramatic drop in services as the economy went through lockdown, and a large pop in durable goods as interest rates came down and government stimulus was pumped into the economy. And we could see even more dramatically in 2021, with the only major difference here being a drastic recovery in services as the COVID lockdown restrictions, they eased. Then came 2022, the Fed started raising interest rates, and that COVID stimulus started to run dry, and we could see a large drop in spending across the board, especially in durable goods, as higher interest rates made it more expensive to buy things like cars and, appliances and such. Then in 2023, we started to see some normalization in spending, which has continued through this year. And this is very important and a healthy sign for sustainable spending going forward. And quickly on the chart on the right, here we're looking at the personal savings rate for the US consumer. And what we're seeing here is consumer savings spiked dramatically during the pandemic, then dropped near 60-year lows during 2022, but has been steadily increasing since then. Now, we're still only, at a little over 5% of disposable income, which is below that 60-year average of 8.5%. but the year-over-year increase since 2022 is a sign that the consumer is healing from 2022 and continuing to head in the right direction. On the next slide, let's take a look at the US labor market. Now, if you heard, me on the radio, or if you sat at a meeting with me or listened to a previous webinar, you've heard me say that labor is the foundation of the US economy. Without a strong labor force, you can't have a strong consumer. And without a strong consumer, you do not have a strong economy. And at first glance on the chart to the left here, which looks at non-farm payrolls on a month-over-month basis, you may think that this graph is challenging for labor as it, kind of steadily goes down. But in actuality, what we're seeing here is a normalization in the labor market from COVID. I always say labor is not a sprint race, it's a marathon, and that's where we're currently getting to, a pace that's sustainable for growth moving forward. And this was evident in September's jobs report, where we added 254,000 jobs, well above that estimate of 140,000 and well above that 3-month moving average of 116,000. Now, another healthy sign in labor is the labor force participation for prime age group workers, which we could see on the chart to the right. Prime age group, which is ages 18 to 64, which is highlighted in that light blue line, has now reached higher than it was in the pre-pandemic, signaling that we're moving towards a fully employed America, which is also evident in our current unemployment percentage of 4.1%. On the next slide, let's take a look at inflation. Now, the good news here on inflation is that it's almost back to the Fed's target of 2%. The bad news is this is another quarter that I feel obligated that we need to discuss inflation. I'm truly hopeful by the State of the Economy presentation in January that I won't even need to mention inflation, but nonetheless, we could see both the headline and core inflation both breaking below that 50-year historical average on the chart to the left. And while this is a much welcome sign, inflation still sits slightly above that Fed's target of 2%. We received September CPI numbers earlier this month, which showed inflation coming down to 2.4%. So we're getting very close. And one area that I wanted to highlight, and I believe to be a continued factor in lowering inflation, is energy prices. If we look to that chart to the right, which shows global oil production, we could see that production has reached pre-pandemic levels, which will help and is already helping the supply and demand imbalance that we've seen over the last few years. So just to recap here, the economy shifted from an expected recession in 2023 to a projected soft landing. Consumer spending remains key and continues to show signs of normalization post-pandemic. And that's very important since it makes up over 70% of GDP. Labor market continues to stabilize with strong job gains and prime age group participation surpassing pre-COVID levels. And finally, inflation is nearing the Fed's 2% target, supported by falling energy prices and strong oil production. So the next part of the presentation, we'll talk about the Fed and the fixed income outlook. So we've had a major change since our last economic update last quarter, with the Fed cutting interest rates by 50 basis points last month, bringing the target range now between 4.75% and 5%, which we could see here on the right on the chart, that says 4.88%. Now, both the Fed's forecasts and the market are in agreement that further easing is to be expected, and we could see that with the where the Fed estimates are, which is highlighted in blue, and what the market expects, which is highlighted in green. The economic data supports this. Remember, the Fed has a dual mandate. That's maximum employment and stable prices. We saw on the inflation slide that prices have come down almost to that Fed's 2%. And we saw from the labor slide that we're near maximum employment, with the unemployment rate near that historical low of 4.1% and that labor force participation rate higher than those pre-pandemic levels. The only question here is the pace and the gravity of how the Fed cuts from here. And as of now, the market is pricing in around a 70% chance that the Fed cuts another 50 basis points at December's meeting. So let's take a look at what this means for the bond market. Now, I've brought this up before on previous economic updates that the outlook for bonds is very attractive, which certainly has not been the case for bonds over the last decade or so. When we couple the fact that rates are as high as they are, in almost 20 years, and that they're coming down, this is really that perfect environment for bonds. This chart right here quantifies exactly how good of a spot we're currently in. Here we're looking at the correlation between yield to worst for the US aggregate bond index, which means exactly how it sounds. It's the lowest possible yield in the worst case scenario, and its 5-year annualized return. And if you look to the bottom left of the chart, the yield to worst for the ag as of quarter end is 4.23%, which forecasts an annualized return of 4.3% for the next 5 years. These are very attractive return forecasts for fixed income. On the next slide, let's take a look at some more historical numbers. So just like stocks, fixed income will experience volatility throughout the year as well. This chart shows the intra-year volatility for the ag, which is highlighted in red, versus the calendar year return in gray. And we could see here that despite an average intra-year drop of 3.5%, annual returns for bonds were positive in 43 out of the last 48 years. Something else I like to point out are the ag's returns after negative years. And we could see this in 94, 99, 2013, 2021, and 2022. And if we use 94, 99, and 2013 for more of a historical reference, the ag had very strong returns after posting a negative return for that year. And we could be seeing the start of that again after posting a negative 13% rate of return on the ag in 2022. But overall, the point of this graph is to show that fixed income too will experience volatility. And it's important to remember the core principle on being a long-term investor and knowing that the outlook moving forward is an attractive one for bonds. In the next slide, I'll highlight one area specifically we're looking in the bond market. So one area where we've been specifically targeting within our clients' portfolio are corporate bonds. Corporate bonds offer some higher yield compared to treasuries because you're taking on credit risk from a specific company. And when we reviewed the economy portion of the presentation, we saw that the economy is doing well, which makes sense to be taking on some more additional corporate exposure. But on top of that, high quality corporate bonds are trading at some very attractive valuations. This chart here is looking at valuations going back to 2003. And when the price level is below 100, it means that bonds are trading under par and being priced at a discount. And anything above 100 is above par and being traded at a premium. And what we could see here is all the way to the right is that even though corporate bonds have bounced off their recent lows, they are still being priced at a significant discount, especially from historical level. And for those reasons, we've been targeting specific areas of corporate bonds within our client portfolios. So to recap here, Fed cut rates by 50 basis points last month, with more cuts likely as inflation nears 2% and employment remains steady. Bond market outlook continues to be attractive, with the ag's current yields forecasting a 4.3% annualized return over the next 5 years. And bond volatility is normal, but bonds have delivered positive returns out of 43 out of the last 48 years, and have rebounded strongly after negative years, which we just saw in 2021 and 2022. And finally, corporate bonds are trading at a discount, offering higher yields compared to treasuries, which are primary reasons on why we hold them within client accounts. And for the next part of the presentation, I'll pass it back off to Ryan.
Great, thank you, Paolo. And so for the final section, we'll be talking about, I brought it up earlier, that changing market dynamics in a look ahead. So we'll jump into a number of slides and charts that I think help explain what we're seeing today in the market, and ones that I found quite interesting. So Halloween scare, I know Paolo showed the data and the evidence that obviously inflation has been coming down. It's been coming down for quite some time. But we're seeing a little bit of a maybe a reignition of inflation with the latest September CPI report. And I don't know about you, but I have three kids, 5, 7, and 9, and Halloween. It's all about Halloween in my household now. I'm just hoping that they can settle on their third, fourth, fifth choices for Halloween costumes as we get closer to it next week. But thought this was funny with inflation. It's alive still, and again, I think it dictates what we're seeing, especially in the fixed income market over the last 30 days or so. And we'll take a look at what some of those charts look like. Earlier in the presentation at the start, we showed kind of what that year to date in the equity markets looked like. This is more of just isolated to the third quarter. And what's changed? Well, you see the two leaders. Before it was the S&P and the NASDAQ. In the third quarter, it was the Russell and the Dow. So you kind of saw small caps leading the charge for a little bit. You saw a real big divergence early in the quarter. When we first started getting really kind of weak economic data, more expectation of rate cuts ahead. And then you have the Dow, which is probably a little bit more value oriented versus what we see in the S&P and the NASDAQ, which are a little bit more higher kind of growth and technology weighted. But you see, even though there's small divergences, you see much more of a narrowing of all those major US indices. And what does that mean, or why is that happening? Well, let's kind of take a look at what we're seeing in the data. I like this. I use this in our quarterly write-up, our market update and commentary that we sent out last week. And I know it's not all about the Mag 7, but the Mag 7 have been a huge story over these last 2 years. You've seen that, really helping move this market forward. You saw a huge upswing last year. You're still seeing leadership in those 7 stocks so far through 2024. But we're seeing a little bit of a change into the third quarter. And in the dark blue, bar graph is the Mag 7, the, teal blue, the lighter blue is the rest of the S&P, excluding the Mag 7. And this kind of goes back over the last 4 years and shows kind of expected earnings growth. And you can see where we're circled today, where we're at sort of mid towards the end of the year for 2024. But you see, that slowing down maybe of the growth expectations of the Mag 7 versus what we saw in 2023 entering 2024. The Mag 7, the growth and earnings expectations were so much higher than the rest of the market. And that played out. I mean, for a long time, the rest of the market wasn't even in a positive territory in 2023. But you're seeing, those other areas of the market start to come into favor. And that's where you see, whether it was the Russell or the Dow start to do a little bit better than maybe the NASDAQ again, which is more technology weighted. So you're seeing more market participation, and I think a little bit more momentum for those other areas of the market. Yeah, I thought this is an interesting graph. Again, this kind of goes to that theme of this market rotation that we're seeing. We've had high interest rates for some time, but there's been different expectations there. And I think this graph goes to show, what value versus growth companies do in different interest rate environments. That first, on the left, it's the green is growth, the gray is value. The left-hand side starts at 0 to 2% rates for the 10-year treasury, 2 to 3%, 3 to 4%, 4 to 5%, then everything over 5%. And as you can see, once you get to the 3 to 4% and above, value is right in line, I guess, with growth there. But as you get higher, value stocks tend to do better. For growth stocks, higher interest rates tend to be a headwind. The way you price stocks using a discounted cash flow model, the higher the interest rate, the less that future growth kind of plays into that current value. And even though we've seen, again, with higher interest rates over the last few years, the story with growth and technology companies was the advent of AI and what AI brought to the table. And even though the Fed has started to lower rates on the short end and lowering their federal funds rate, we've actually seen an increase in the 10-year treasury over the last 30 days or so. And so, our expectations that we may have a little bit higher of interest rates, especially on the long end of the curve, even with the Fed moving rates down. And I think this just goes to show that in that higher interest rate environment, there are other areas of the market that tend to do well. And we've shared in the past, we're not really so much tied to pure value type holdings within our portfolio, but some of those more quality companies, some of those other areas, maybe those dividend growers, tend to skew a little bit more on the traditional value side. But again, we kind of use a different factor to get exposure to it. If we look at the next slide, um, you know, using the slide and for a couple of reasons, right? If we think about, is there concern of that bear market? We talked about in the last webinar too, all the concerns and headlines that are out there that could have us be hesitant to want to be invested or to be fully invested in the market. And I think this is a really interesting graph. It shows the last three, I would say, major bear markets that we've experienced over the last 20, 25 years. You have the tech bubble, you have the financial crisis, and you have COVID. And when you look at large caps in gray, mid caps in green, small caps in blue, you see the number of unprofitable companies that are made up during those timeframes. And you look at the tech bubble, 28% of large cap companies were unprofitable. If you remember, especially the leaders at that time, there wasn't a lot of profitability in those areas of the market. And I think that's the big difference of what we're seeing today. Yes, there's been concern that, hey, we have a very concentrated market. I think the top 10 companies in the S&P make up about 35% or so the overall market. And that could be concerning. We've never seen it that high before over the last 100, 150 years. But when you look at profitability, earnings growth, profit margins, all these other factors, a lot of these companies, believe it or not, are doing quite well. And so, that gives us less concern when you look at the overall market. And this also, if you go to the right side where it says the current market environment, another reason why we tend to prefer large caps versus small caps, as you can see, the small caps in terms of how many are unprofitable are just in line with some of those previous market bubbles or market declines. But when you see 41% of small caps are unprofitable, again, that gives us a little bit of hesitation to be overweight, even though they're probably undervalued relative to large caps at the moment. I think we feel more comfortable being in some of those large cap names that, again, are doing well, are profitable, strong earnings, and continued earnings growth. So outside of the sort of the equity themes that we're seeing in some of that rotation that we've talked about and that changing of the market dynamics, let's look at the impact of what the Fed has done over the last 30 days and what we're seeing in the interest rate market. I know Paolo did a great job talking about the fixed income market, where things stand and what the Fed has done. But I mean, it is really, really interesting when you see, September 19th, I think, was when the Fed cut interest rates by 50 basis points. So you had the Fed on the short end of the curve lowering their overnight Fed funds rate by 50 basis points. Since then, we've seen the 10-year Treasury rise by 60 basis points. And I think everyone thought, hey, when the Fed starts lowering rates, mortgages are going to get cheaper, car loans are going to get cheaper, consumer loans, whatever they tend to be in your, what you need or what you're looking for, are going to be coming down. And we've actually seen just the opposite. Now, it's only been a 30-day snapshot of that, but it just is interesting in terms of what really drives the yield curve, both on the short end versus on the long end. And we've said it over and over, and it's going into maybe some changes that we'll see in the coming weeks or months, that, hey, there still may be an opportunity on the longer end of the curve to get exposure to fixed income. And that's why we're kind of seeing that shift for us, going away from the short end where rates are coming down. We're not going to get as much yield. Maybe you've been sitting in, money markets or CDs that, are only, day to day or, 3 months, 6 months. As those rates come down, we're going to want to look at how can we get exposure with good interest for locking it in for longer intermediate periods of time. And like I said, I think this is quite fascinating that the 10-year has risen as much as it has in the last 30 days. There's no set playbook for where rates go from here. Again, this is just a 30-day snapshot of the previous 6 times when the Fed started lowering rates, plus in dark blue at the top, that line is what we're seeing so far since the Fed lowered rates, about 30 days ago. This chart's from a week or so back, so it doesn't fully go the full 30 days. But as you can see from the previous 6 instances when the Fed started cutting rates, 2 cases, the rates started coming down on the 10-year Treasury. The other 2 cases, they stayed relatively flat. In the other 2 cases, they actually went up. And so, in terms of what the Fed is doing, that longer end of the curve is dictated a lot less by some of the Fed's decisions, but more by what's going on in the economy, where we're seeing, some of those inflationary concerns creep back up, which I think is really driving what we're seeing in the 10-year right now. And this chart kind of shows just that. I think we had 18 straight months of CPI coming down since about March of 2023. And like I said, that latest September reading, we actually saw just not much, but just a really slight uptick in what that reading was. So again, who knows where we go from here? But I think that number in particular is what's driving a lot of what we're seeing within that fixed income market, especially again, that as the example and the benchmark that we're using, that 10-year Treasury rate. Another topic that comes up quite often, we talk to clients a lot, is the election. So about 2 weeks away from this year's election, and I'm trying to find a different type of chart to show or use. I know we've been talking about this at every election cycle going back over the last 12 years I've been with the firm. So this is probably the 4th time we've kind of gone through a cycle like this. I thought this one was pretty interesting. So on the horizontal x-axis, you see annualized GDP growth, so percentage of what the annual GDP percentage growth was. On the left hand, the y-axis, the vertical axis, is the annualized stock market performance for the S&P, depending on which president was in office. So this goes back 70 years or so, 13 different administrations, and as you can see, whether it's Republican, Democrat, really at the end of the day doesn't really matter. I do think it's interesting that the only 2 administrations where the market was down over time was 2 Republicans. Again, I think that has less to do with whether it's Republicans or Democrats in office. I think it's more market cyclical and economically driven on other factors. But I do think it's worthwhile to see that, again, at the end of the day, whether it's Democrats, Republicans in office, I've said it before, we've had Trump in office in the past. Kamala is coming from, the current administration. We kind of know what we're going to get to a certain extent. I think should be less fear and uncertainty. And again, that was the headline for most of the year, right? This big uncertainty with the election, how it's going to impact the markets. And as we saw from before, year to date, the market's up over 20% yet again. I saw this just one other way, I think, to kind of explain or see and talk about the upcoming election is that, when we look back over the last 4 administrations, right, we've had a Democrat, we've had Republicans, we've had a Democrat and Republicans with George Bush. You go back to 2000. The bigger issue in terms of what's going on or where the market is going, it's really about us and how we feel. So this chart is showing consumer confidence. So the red is Republicans or someone who leans Republican. The blue is Democrats or someone who leans Democratic. And it shows what their consumer confidence is in those different instances. So on the left, starting with George Bush, you go into the Obama years, you had the 4 years with Trump, and then you go to the almost 4 years with Biden. And it is a stark reversal. If Republicans in our office, Republicans are feeling a lot better about the economy and where they're at. If Democrats are in office, they're feeling a lot better where they're at. And maybe there's, areas and instances where that rings true and where it actually does have an effect. But what we can't let it happen is dictate our behavior or let it dictate what we're doing from a investment and portfolio perspective. We have to be disciplined, take some of that emotion out of it, because as we can see, it's so tied into, our feelings on, politics and where we lean that, at the end of the day, as we've seen, more times than not, that market in stocks are going up and to the right. So just try not to let it dictate what you're doing from an investment standpoint. I do think if we're going to talk about any uncertainties around the election, probably the one area of volatility that we could see is if, there's some uncertainty over who actually won the election. Hopefully, if that is the case, that gets, cleared up and figured out quickly. But I could see, if any concern surrounding the election, that would be the one maybe area of concern. But again, I don't think it should impact any longer term investment or portfolio decision-making process. So with that, what lies ahead? This is a very simple graph of just the last, I don't know, almost 100 years or so of what the market does in the fourth quarter. And outside, all the way on the left-hand side of, the Great Depression, the fourth quarter tends to be, generally a pretty good time to be invested. It's usually a good quarter in the markets, and more times than not, as you can see, the market is positive during the fourth quarter. Doesn't dictate what's going to happen this year, but just looking backwards, like to see and look at the data. From an economic standpoint, we've talked about the soft landing for quite some time. Is it possible that we're entering a no landing area, meaning that, the economy maybe doesn't slow down as much as we thought it could? We're seeing actually an uptick in GDP growth. The estimates for the third quarter are at 3.4% from the Atlanta Fed. We're seeing a lot of momentum there in the economy. And to Paolo's points earlier, the economy, the consumer, the labor market is going to be a huge, dictator of what we see moving forward. And, so far we're seeing pretty solid momentum in 2024. Economic reality versus expectations. This is the surprise index. Essentially, it's what's happening in the economy versus what were consumers' expectations. And as you see, this goes back 12 months. For most of the end of 2023 and the beginning parts of 2024, economic reality was actually getting worse versus what people's expectations were. And so you kind of saw that. We saw as we entered the third quarter, markets a little volatility. We saw a brief pullback to start the third quarter. But over the last couple months, we're actually seeing economic reality becoming a lot better than what expectations were. And again, is that a little bit more of a bounce and some more forward momentum? We've seen jobs report come back stronger. We've seen, GDP growth have a little bit of an uptick. We're seeing inflation uptick a little bit. Whether that's good or bad, again, I think we're just seeing strength in the overall economy, which, by and large, is going to be a good thing for markets moving forward. Yeah, this is my last slide kind of showing that. So looking back on the last 8 market cycles when the Fed started lowering interest rates, what happens from there? We've talked about and we've shown charts in the past. Typically speaking, if the Fed is lowering rates, they're trying to stimulate the economy. So what's going to happen to the markets moving forward? Well, to us, it's really about the economy over what the Fed does, whether they keep rates as they are, they lower them more aggressively. That will probably be dictated by what the economy is doing. And what this chart shows is, again, in blue is the market at the Fed rate cut in the middle, what the market has done over 5 instances of lowering rates when we haven't hit a recession. The gray bar or the gray line is the median of what the market, what the S&P has done in 3 instances where the Fed started cutting rates and we entered a recession. As you can see, it's not so much about what the Fed is doing, it's really about what the economy is doing. And so as we move forward from here, the economy is really, I think, going to dictate more than anything what the markets do and what we see moving forward. And like I said, from the previous slides, we are seeing some, relatively solid strength in growth in the economy. And I think that should bode well for stocks as we enter the fourth quarter. So to wrap it up, U.S. equity market shifted during the third quarter. We're seeing a market rotation. We're seeing some other sectors and area of the market do well relative to what they've been doing over the previous 18 months or so. We're seeing expanded market breadth, a lot more market participation, which is always a good thing in a healthy bull market. As I said, that's all positive as we move forward. The Federal Reserve cuts and the impact, we're seeing less yield on those short durations. Part of the reason why, to Paolo's points, looking to move out on the yield curve and use some other areas of the bond fixed income market. Then not everything is going down with cuts. As we saw, the 10-year Treasury note has risen quite dramatically in just the last 30 days. So just an interesting aspect of the current market that we're watching. Election results, again, I think this is more personal than anything. Wouldn't let it dictate anything we're doing from the investment side of things. And last but not least, economic resilience to close the third quarter. We're seeing strong economy and earnings moving forward, I think will dictate the market more than anything else. So with that, that's today's presentation. Thank you so much for joining us. Like I said, we will be sending this out in an email, so you'll have a video of the presentation as well as the slides that we use. So if you want to look back to anything and look at what we shared. And as always, if you have any questions, if this prompted anything in your own situation, never hesitate to give us a call. So again, thank you so much.